Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me back, Jim.
Wolf, can you give us an update on the new vehicle market?
This is probably the craziest situation I have ever seen in my entire life. And right now, what is going on in the United States is that prices are sky high, sales have collapsed, and inventories have collapsed. And, it's very difficult to even estimate what demand is. Sales have collapsed by about one-third since April this year, and they're down a whole bunch from a year ago. We're looking at the worst sales in September since 2011, when the United States came out of the financial crisis. So these are really terrible, terrible sales. At the same time, new vehicle inventories are at a historic low. There are actually no vehicles, no popular models in inventory. They get sold either via ordering or when they come off the carrier at the dealership. And GM said yesterday, for example, that its average day supply of inventory is in the 20-day range. So it's something like 25 days, but that includes in-transit units. And it takes a long time for these units to make the way from the assembly plant or the port to the dealer and then get prepped. And there's days involved. So this is a situation where potential car buyers go to the dealer and they don't find what they want. They don't find really anything. And so now I think there's some indications that some people have thrown in the towel. So they kind of look at this circus and say, I don't want to participate in this anymore. I'm just waiting. I'm just going to wait till it's over, And customers have done this before during or right after the financial crisis when auto sales collapsed in the United States. Customers just refused to buy. And they did that for several years, and sales didn't come up for a long time. Most people drive a vehicle that can be driven for a year or two longer, or maybe many more years, and they don't really have to buy a vehicle. It's a discretionary purchase. So they can step back and not buy and just wait this out. On the other hand, there is still enough demand to maintain those high prices, and that's constantly stories of people buying trucks, paying $10,000 and $20,000 over sticker to get them. There used to be this attitude that people would negotiate over cars, the price, and now it's just like the other way around. They're outbidding each other. And at the same time, we have this completely screwed up supply chain for automakers. But GM said on Friday when it announced its earnings that it had shipped to dealers some 65,000 trucks that were mostly assembled previously and then had set on a storage lot near their plant somewhere until the final parts came in that were missing. So there were some missing parts due to the chip shortage, and when those final parts came in, so this could be a rearview mirror or some other device that had some chip in it, they would install it and then ship that vehicle to the dealer. So they had shipped, in the last quarter, they had shipped 60-some thousand vehicles of that, or pickups of that type, to the dealers that they had previously in prior months assembled and just weren't finished. Now, every automaker is struggling more or less with this, and it's astounding. Now, Toyota has had a deal with its chip suppliers to where they would have to have enough inventory on hand to prioritize Toyota sales for a certain number of months, and that deal was put in place after the Fukushima earthquake and tsunami that essentially scrambled Toyota's supply chain. So it learned a lesson and it put that in place, and that came out earlier this year. And so Toyota was doing great getting chips, and it became the number one vehicle seller in the United States until September. When it ran out of chips when those supply chain agreements ran its course, and then in September its sales fell, and and it dropped off, and Tesla doesn't really have a lot of issues getting chips apparently, and it has a big plant in China, and it's really pushing its China sales, and maybe it worked some special deals that some of the other Asian makers and Korean makers didn't really have a lot of chip issues either. Ford had huge chip problems earlier in September. It started to get some inventory, and it became number one in September because GM had trouble building vehicles. Toyota dropped off the face of the earth, having gotten hit by chip problems, and Ford was just gotten some back orders and was able to get some units out. And Ford sales dropped 18% in September from a year ago. 18% is a big drop. But it dropped a lot less than the other automakers, and that catapulted Ford to the number one place. And so this whole industry hierarchy has been upended by this chip shortage, with some automakers getting more and others less, and the pricing situation is just ridiculous. The amount of money people are outbidding each other, to get these vehicles, and GM reported that the average transaction price in the third quarter was up by 20% from a year ago. Now, the average transaction price is a mixture of just plain price increases and cutting for automakers. That means cutting incentives and switching, prioritizing higher end models. And that's what GM and what all of them are doing. Yeah, they're just really focusing on higher end models. That's what they're selling, but that's a huge increase, 20% in the average transaction price year over year. And people are paying this. They're buying these higher end models, and they're scrambling to get them. You hear it all the time. They can't get a regular pickup, so they're buying the high end pickups, and that's what automakers are building so they can maximize their profits. And this is just a chaotic situation, and automakers, their supply chains used to be very efficient, extremely efficient, and now they're just all scrambling. It's inefficient. It takes untold hours to try to keep this in line somehow and to procure the parts, and so there's a huge loss in efficiency there. And I don't see this abating this year, so it looks like sales are going to be down 20 to 30% this year compared to the peak, which was in 2016 and in the year 2000. So in the United States, vehicle sales really haven't moved at all in 20 years. So in 2000, the United States reached 17 million, a little over 17 million new vehicle sales for the first time, and then sales plunged from that point on and bottomed out in 2009, and then in 2016 we're back at that just over 17 million unit range, and then fell off again. So this is not a growth industry. The only growth you get is from selling higher end units, or charging more dollars for each vehicle, and that's what they're doing. And now this year we're looking at maybe 15 million units if the industry is lucky. Last year we were at 14.6 million units. This is a tough industry to begin with, and now with the shortages, it's just chaos.
We'll have more with Wolf Richter right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Wolf Richter. Wolf, is the new vehicle market continuing to disrupt the used vehicle market?
So the supply, the answer is yes. The supply in the used vehicle market comes through the new vehicle market, and there's two big sources of supply for the used vehicle market, and that's the rental car companies, and they in a normal year order about 2.5 to 3 million vehicles in the U.S., new vehicles, and they cycle them through, and then they go to the auction and are sold to dealers. And then the other source is through trade-ins at the dealer level, and of course the repossessions and lease turn-ins and those kinds of vehicles. And now that new vehicles are not manufactured in enough quantity, automakers have prioritized retail sales, and they have de-emphasized fleet sales to rental car companies. And rental car companies have been shortchanged, so they're keeping what they have much longer. So rental car mileage is going up on these units, and you can buy a rental car with 80,000 miles on it now. And the outflow from rental car companies into the used vehicle market has essentially collapsed. And so there is a supply shortage from that end. And also on the new vehicle side, since there are not enough new vehicles out there and new vehicle sales have plunged so far, the trade-ins are lower. And that too crimps used vehicle demand. So throughout the year so far, we have seen a shortage of used vehicles, not nearly as bad as in the new vehicle market, but a relatively pronounced, and prices have completely spiked. And, at one point they were up over 40% year over year, which is completely crazy. The wholesale prices in September, after dropping a little bit in the prior month, they picked up again. And so it doesn't look like that this will abate anytime soon. I just can't see it. Now there is inventory in used vehicles, but it's very tight, and there is flow into the used vehicle market, but it's not nearly as large as it usually is. And the shortage in new vehicles has caused some new vehicle buyers to try to find something used, and they're paying more money for a used vehicle than they're doing for an equivalent new vehicle if they could get it. And so you have that demand in there, and you're back to that situation where a vehicle is a discretionary purchase. You can drive what you have for a while longer, and that's kicking in. So volume is down too, and customers go to a dealer in the shop, and they see the high prices, and they see the lack of inventory, and many people are just discouraged. So I don't see any improvement there this year, and maybe next year, but it will take a long time. The rental car companies are still not getting their units. They're still having trouble procuring their fleet units, and so that lack of supply will drag into next year probably.
We've heard predictions the chip shortage could continue into late next year or even into 2023. What are you hearing?
Yeah, so I hear 2022 for sure. At first, earlier this year, we were told that all this will be over by the end of this year, and that's completely out the window now. That there's nobody saying that anymore. So it's definitely going to be dragged into next year. I don't know. There's a lot of activity now among chip suppliers to get this corrected because it's profit opportunities. I think the bigger issue here is why some automakers are getting chips and why others are not getting chips, or at least why some automakers are getting more chips than others, and there are now questions about potential hoarding by some Asian automakers that are perhaps close to the chip makers. And this could be, a lot of the chip plants are in South Korea, and the South Korean automakers don't have that kind of problems procuring chips that U.S. automakers have. Tesla has been doing pretty good getting chips. maybe because it is using a different kind of chip. So a lot of chips that are really in short supply are these cheap, old chips that are used to control review mirrors and door locks and that kind of stuff. And these are low-cost chips. They're low profit margin items, and there are not a lot of manufacturers that make them, and nobody's paid any attention to this stuff for years. And this is technology from the 1990s, and those chips are doing just fine to control a door lock. And so maybe a manufacturer like Tesla has focused more on more recent chips and taking a different approach, and may have been lucky in that those chips are not in short supply, and but it sales year over year up over 70% globally. So clearly they're getting more chips than they did last year. And on the other hand, Ford and GM and many of these other manufacturers are getting fewer chips than last year. So these are the things that are now circling around. How come some automakers are getting chips and others are not? And why is that? And is there hoarding going on? Is there preferential treatment going on? What are automakers doing to get the supply? And this is going to be part of the resolution, time to sort this out. And I just switched my website to a new server, and so I had to get a server. And if you don't insist on getting what you want, if you can get just anything that will do the job, the chips are out there. So I'm not particular about my server. It has to have powerful enough chip, but it can be anything. And I had no problem doing it. Now, but if you're looking, and these are server type chips, and if you're looking for something specific, you may wait a year or two to get it, even though you could substitute it with something else. But automakers can't do that. Their designs were set years ago. They have very specific specifications. They cannot change that design, and they cannot substitute one chip for another. So, there's really no flexibility in the supply chain. These are, they take a long time to build those supply chains, and their specifications all the way up. If you try to make one small change, it's going to cause a huge warranty problem down the line for automakers. So they can't do what I did. They can't substitute one chip for another that's available. And that's part of the problem, is that rigidness of auto production, which takes a long time to design and build a model, manufacture. By the time it gets manufactured, from the time it gets planned, it's a long time, and he can't change that. So, if there were more flexibility in the supply of these things, it would be a lot less difficult to deal with. But that's just not the case with these complicated, complex, expensive products such as an automobile.
The possibility of a U.S. default is now front and center. Why is this even an issue, and what are some of the primary concerns?
Yeah, I call this a farce, and this is an integral part of the American system. And when you look at it from the outside as a foreigner, it just sounds, this is the most astounding thing that this could ever happen. Essentially, the way the system here is set up is that Congress passes legislation that tells the government what to spend on what item, so over what time period, and exactly, the amounts, and including all the pork barrel, all the projects for the individual members of Congress and the district. And so this is enshrined in law. Every year, that the government is told how much to spend on which item and over what time frame. And then Congress has set separately a limit on how much money the government can borrow. So on one hand, it tells the government to spend this money, and on the other hand, it prohibits the government from borrowing more than that limit. And the borrowing is required to fund these programs. And there's tax revenues, and then the difference has to be made up by borrowing. In the United States, we've had a deficit for a long time, and so this amount is huge. and that needs to be borrowed, and Congress knows that. They know exactly how much money needs to be borrowed to fund the programs that they're putting in place. So this whole thing is kind of crazy. Yeah, on one hand, the Congress tells the government how much to spend, and on the other hand, Congress tells the government, no, we don't allow you to raise the money to spend this money that we told you to spend. And the debt ceiling was invoked again on August 1st. So the government cannot borrow more than that amount that was outstanding at that time. Now, this has happened many times before. This is a standard feature in the American system, and it's happened, according to the Treasury Department, like 78 times since the 1960s. And each time it gets resolved, and it looks like this time it's going to get resolved too, and that's why I call it a farce, because we know in advance how this is going to end up. This is going to end up getting resolved before the Treasury Department defaults on its Treasury securities. And if it doesn't get resolved, if some point along the line somewhere something crazy happens and it doesn't get resolved, the United States would default, and this would have catastrophic consequences on the financial markets, because it's the most liquid government securities market. It is huge. It is now you're talking $28 trillion in total debt. This is a huge amount of money. It's everywhere. It's leverage. It's rehypothecated. The derivatives based on them. You have a huge repo market that's based on it. So these are gigantic amounts of money that are suddenly, where the flow would suddenly be jeopardized by a default. And so the consequences would just be catastrophic. And it's just almost funny to contemplate that they would purposely try to get even near that. And so they don't. The members of Congress, they're wealthy, they have assets, and the value of those assets would be just crushed by a default. And so they're not going to do that. There's enough self-interest there to not even get close to that. And it looks like they're now coming up with a solution to this. Now, it is used every time it comes up as a way to extort certain things from the other side, and it's a political brinksmanship game. It's a terrible thing to do, and it should be abolished. And but it's a power game that Congress likes to play, and so everybody always hopes that nothing goes wrong, that they can figure out how to resolve that, and they'll come to a solution. And they will this time too. I'm pretty confident of that. The threats are out there everywhere. S&P came out a week ago and said it would downgrade the United States by 20 notches, from a AA plus where it is right now to D for default in one fell swoop, if it defaulted on its Treasury securities. It's just almost funny to contemplate all these things, but it's not funny. It would be just catastrophic if it happened, and it's just one of the crazy aspects of the American system that should be abolished. It's ridiculous to have something like this in place. It should be abolished, but I doubt it will get abolished. They're going to deal with it. They're going to solve it for a short period of time, and then we'll start all over again. And that's why I call it the debt ceiling farce, because that's what it is, and I've reported about it every time it happens. And then the debt ceiling issue gets resolved, and then the next day the debt of the United States jumps by 400 billion or 500 billion in one day, because the debt ceiling never actually causes the United States to borrow less. It just temporarily puts a lid on the securities that are outstanding, and then after it gets lifted, the debt just spikes by huge amounts to catch up with what should have happened in the prior weeks. And I have these tongue-in-cheek articles at that point writing about these enormous spikes in borrowing that come after the debt ceiling issue gets resolved, and that's why it doesn't solve it. It doesn't do anything. It's just a political brinkmanship game. It's designed to harass the other party. it's designed to extort some benefits out of the other party, and it puts at risk, the financial markets. But so far, knock on wood, it's always gotten resolved before we have some kind of a catastrophic event happen there.
Does it look like inflation is turning into stagflation?
Well, inflation for sure is a lot more persistent than initially promised, and a lot higher than initially promised. And in the United States, we're now running, depending on which government measure you're looking at, between 3.5% and nearly 6% annual inflation. And that is far, far above the Federal Reserve's target. It's far above what the Federal Reserve thought a few months ago we would get. There are now lots of dynamics in place that will push inflation up over next year and in future years. So this looks like a persistent thing. So stagflation has two elements: inflation and slow growth or no growth. And so the inflation part is in place. So unless the Fed really hammers this down through rate hikes and its balance sheet unwind, this inflation is just going to keep on going. So the other part of that question is growth. So far, growth has been exceptionally strong, and coming out of the pandemic, it's the most grotesquely overstimulated economy here ever, and there's $4.5 trillion in fiscal in monetary stimulus from the Fed, and $5 trillion in stimulus from the federal government that was borrowed. The $9.5 trillion in stimulus that was just thrown out there, and this is now embedded in many layers of the economy, from states that have received this money and they're sitting on it, to consumers and to companies, and this money is out there, and it's gradually getting used in the economy, and it continues to stimulate the economy forward. So right now, I don't see how this economy could seriously slow down at this point. Now, 2% growth per year for the United States is good. We haven't had a 3% growth year since before the financial crisis. So it's been a long time. And so when you talk about slow growth, it would have to be slower than the normal growth for the United States. So slower than 2%, slower than 1%. And we've had years of 1%. And so you have, high inflation, 4 or 5%, 6% maybe, and growth adjusted for inflation of 2%, and or 1%, and if it goes to 0%, it would be really bad. And this is a tricky situation, because when you have slow growth and high inflation, the Fed has difficulties in trying to deal with this. And, you raise interest rates and, essentially to slow down demand, which would, eventually, slow down inflation. And, but if demand is already slow, it's hard to do that. So stagflation is a nasty problem to have. And, it's hard to kill inflation when there's stagflation, when the inflation persists, even though there's not a lot of growth. And that possibility is there. And right now, I don't see it as a really big possibility, but it is a possibility that we'll get in that kind of environment. For right now, I think there is still so much stimulus out there that growth will be pretty solid, and a lot higher than it used to be. And that stimulus, even if the government shuts down its stimulus operations, and even if the Fed ends its QE, that stimulus is still embedded in the economy. So consumers have gotten it, companies have gotten it, states are sitting on it, and they're gradually releasing this money to buy stuff with, and this will stimulate the economy for quite a while. So I don't really envision stagflation at this point. That's not. That would not be my number one prediction. but I can see it. I can see it as a possibility. What we get now is the Fed is tightening. All other central banks are tightening. They're raising rates, and the central banks that have not done QE, they're starting to raise rates. The central banks that have done QE, such as Bank of Japan, the Fed, Bank of Canada, and all those that did, they're tapering their QE, have already started or will start, and some of them are finished with it. Some of them are starting to unwind the balance sheet. So this is the end of the easy money. So markets are not necessarily used to that, and so you will get a reaction from that, and so higher interest rates and end of QE has an impact. And the impact in part will be a slowdown in demand, but that takes a long time to make itself noticed. So, there's a year, 18 months, 2 years lag between a central bank's policy change and when it actually impacts the real economy. And so I don't really envision economic slowdown next year because it's too close. I do envision central banks cracking down on inflation next year, this year already and next year. And so the financial markets are going to feel that. But in terms of demand in the real economy, I don't think we will see that next year. I think this will be further down in the future when we'll see the real demand in the economy slow down because of a central bank crackdown on inflation.
Wolf, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. If you have any questions for Wolf or any of our other guests, we'll ask that question for you. If you send it to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.